Very happy to have Craig Fried on the podcast today. We met each other through a deal, through amazing clients of mine who I've known them and their family for many, many, many years. And you were an old friend of the husband's. And I will say that I'm going to let you introduce yourself because I always get it wrong. But I would say I always get nervous when clients say to me like, "Oh no, don't worry, I have my own lawyer, I have my own mortgage broker." Not because I need to control it a little bit, but I love to work as a team. Also because I never know how good the other person is on the other side, don't get me wrong. And I think we could probably talk a little bit to the deal that we did together, but it was really, really complicated. And you did an incredible job staying very calm and guiding them through it so well. So I'm glad to have you over to talk about mortgages. Don't worry, we're not going to talk about rates today. But yes,
that's good.
Craig Fried, take it away.
Thank you. Thanks for having me.
Yeah.
So I'm Craig Fried from Fried Capital Mortgage and powered by Sherwood Mortgage Group.
Yeah, so similar to real estate agents, you cannot be independent, correct?
Exactly.
You have to, and that's based to make sure that we are all following the rules.
Got it.
Right? So even though I would be Rachel Levy Homes, I work for Slavens, or I am attached to Slavens, they make sure that I follow out the rules as Sherway would with you. And I've written about this in my buyer's guide is... which you bring to the table. And one of the things that I learned from you instantaneously when we met afterwards after that deal was, some of the things when you think about a mortgage broker, the bigger or the more established the brokerages that you come from, the more connections you have. And you would say, well, but connections, like it's just... you're applying for a mortgage, it's a bank, no one's, greasing anybody's pockets, whatever. No, but not every deal is straightforward. And if you need an exception made, that exception will be made by an established, experienced mortgage agent who works for an established brokerage.
Yeah, 100%. We have at Sherwood over $1 billion funded ourselves. And we work with whether it's big banks like Scotiabank or TD Bank or the other monoline lenders. And because we're big and we're good at what we do and we have these relationships, when I send a file into one of these banks or lenders, I know who's picking that up. I know who the underwriter is. I know who the BDM is. So yes, I can have that conversation and get those exceptions done when it makes sense, but really create a story and for them to understand what's going on with the client, why they should accept the file, and get that exception done when needed, 100%.
Hence the deal that we dealt with, that lovely family buying a home that had 2 tenants in it. The good news story is they live there.
Yes.
There's no tenants. It's already they've already filled it. It's fantastic. But getting an exception made for that property because there were 2 tenants was your doing. So well done.
Thank you.
And that was one for the books.
But I
don't
have
you
to
always feel like you're going to write a book one day? I think I'll write a book one day.
On the stuff that you didn't think could happen and how it happens.
And
also kudos to you for, you didn't have a lot of time. Not only that, though, your area where you could find them a property.
I had 4 blocks.
Was like absurd. Like when they called and said, "Hey, we're gonna," I said, "Who do you have?" Where they're like, "Rachel." I said, "Okay."
4 blocks. We had 4 blocks to find a house.
And you found one, though. You got it done, and
yeah, it was not without bumps, but listen, I think they are the calmest, most pragmatic, lovely humans that understood what the ask was and also appreciated all the efforts on every angle and were total team players. And by the way, they left, and this is a great segue into what we're going to talk about today, because I didn't want to have you on to talk about rates. I think there's a lot of rate fatigue. I did a little poll on Instagram weeks ago, do you think the rates are going to go up? Do you think they're going to go down, or do you not care? And there were a lot of people who were like, I don't care anymore. Right. I just don't. Which, by the way, I think is speaking to the market we're seeing, because people are like, I don't care anymore. I just want to buy a house.
And I think we spoke to that a little bit on the phone prior, in terms of people worry about interest rates, and they should. It affects monthly payment. It affects budget. But if you're within budget and you're waiting to time this market or any market, I run numbers for clients to show them. If hypothetically you're looking between 5 and 4.8 or 4.5, the interest cost that you're going to pay compared to what that house could appreciate if you wait is drastic. And
it is drastic. And if you were to ask anybody that's owned a house for more than 10 years, 15 years, like my generation, just throw it in, I'm going to be 50. It's like every episode 50. Now of 2023, I'm like, I'm turning 50. Our parents' generation, they'll be like, oh yeah, I think I remember the rate. Like, I don't remember what I remember the first mortgage I ever, that we got when we moved up was they offered us this rate where it was like the first year. And again, everything the bank sells you is a product, just like on a card lot. Okay. The savings account, your line of credit, it's all a product. Just remember that. So, and they were like, oh, we've got this great new product. And they were like, for the first year, I'm making this up, but like your first year of the 5 years, because again, it's always a 5 year, you only pay 2%, but then, but like your 3 to 5, you pay like 6%. And my husband and I this is like a gazillion years ago, right? We're like, oh my God, it's such a deal. We probably got so like scammed the end of it, but this is again, and I just did a podcast with Jay Pabernick of Asante this morning talking about, the difference between a financial advisor or walking to a bank and talking to their financial advisor. By the way, it says financial advisor, but they're not.
They don't have to be licensed in this province.
And they're not CFPs or whatever, but it's the same idea. Like you speak to Craig and Craig's going to say, okay, so I work with Scotia, I work with TD, I work with National Bank, or I work with, are National Bank considered an alternative lender or they're still part of a major bank?
No, they still are. Yeah.
They're still or alternative lenders. And then again, what makes more sense to you? Because unlike the US, you're going to lock in for 1 year or 5 years. And if we've learned anything through COVID, your life can change dramatically in 5 years. So just do what's right now. Yeah. Anyway, all that to be said. So we're not going to talk about rates. We talked about kind of touching on this idea of moving up. Which I don't think is talked about a lot. We talk about first-time buyers. We talk about potentially right-sizers or whatever, but not this like, there's no like buying your forever home right off the bat anymore unless someone's, the bank of mom and dad is really like in the 1% of the 1%. And they're out there. I had a client who actually bought a house with me sight unseen from Israel. Because they wanted a house that had never been lived in. She saw it online and her parents bought it for her. Crazy.
Yeah, I had a client of mine last year who got gifted $1.5 million and thought it was normal.
I'm available to be adopted. Whoever that was out there, I'm available to be adopted.
I actually had to send the lender details of the parents, like who they were, like CEOs at whatever companies, to prove how the money was going to come to the kids.
Well, because it's sketchy, but it is sketchy. It's like, what do you mean?
Where 23-year-old kids getting that type of money buying down here? Right, yeah, it was
exactly.
Funny. Yeah.
So, I have come across several clients of mine, whether they referred to me or I've dealt with them before, who are in this kind of holding pattern of like, what's going to happen with the market, which is a hard place to be because so first of all, whoever's out there and is in that position, kudos to you because first of all, you're ahead of most people, which is you already
That's
own
exactly
a home.
It.
Okay.
Yeah.
So whether it's a condo or a house or whatever it is that you're in, you own something, kudos to you. You are, there's some people who'd sell their soul to be able to afford that, right? So now the question is that scary next step. And usually, and I remember when we did it, you have that one number in mind that doesn't make, like that you're willing to say out loud. And then you have that other number that makes you a little nauseous. And then the number that would actually make you vomit is the one you end up spending to do the move up, really. But it's a journey and you have to get there. And so, where I am curious is, where do you see the most trepidation or like when you have people reach out to you, what is that guidance? Like, are you seeing people buy up with 5%? Are you seeing people buy up with 20%? I think it's worth touching upon because a lot of people get that confusion. Like, do I need 20% to move up? Do I only need 5%? When is that time where I can take the equity out of my place and buy up?
Great. I mean, considering the market, and most of them are coming from a condo or a townhome moving up into a freehold, you're going to take whatever equity you have, obviously minus the mortgage, into that new place. And so usually you're going to have equity that's built up that's enough to substantiate the move. It's really then an income and assets conversation. So do you have enough income, either yourselves or with gifted down payment or parents or someone else helping along on the file? And I have a lot of parents that come on, like one parent will join the file, and this could be temporary for a year, could be 3, could be 5.
I had that. It's like a 1%. Like it's literally they own 1% on paper, but they are an extra signature
That's
to push
exactly
them over
it.
the edge.
And either their income or their assets, because I do a lot of net worth programs where some of the time the parents don't even have to have an income, but they have the assets. And if you know the right programs with the right lenders, you can get that done no problem on the A side.
Right.
And they'll move up with that equity. And it's really just budgeting at that point. Like, can you afford to make those monthly payments for the principal and interest and the taxes and everything else you're going to need to pay for to be able to make that move?
Right. Because then you also have to think, okay, fine. So I'm going to do, I've got X amount of money. Let's say I have $200,000 worth of equity in a condo and I want to move up. And that's not, 20%. That's not what I need because I also have to make sure that I pay land transfer tax, right? Because land transfer tax is not nothing. And if you're moving in Toronto, you get double hit. So then you have to minus that off of your equity because most people don't have that sitting in their bank account. And you also need, your legal fees and that type of thing, right? So once you have that done, I think it's true. It comes down to whether this is a good time or not. And I think, is it ever a good time? Well, Are you ever ready for children?
Yeah, I mean, yeah, that's exactly it. And I think once they need, obviously, over $1 million, you need that 20% down, right, across the board. And then it's a matter of, do you have extra? Do you want to put that down? And it's the opportunity cost of what you're doing with that capital.
Right.
But at some point, just like moving into your first home, you have to take that step to get you. And all of this sort of waiting, as you can kind of speak to more than anybody, it starts to appreciate. And then you're so worried about rate or whatever else, and you've missed that opportunity.
Right.
Instead of just saying, okay, let's run those numbers to see how we can make this work. And whether it's with a lending or alternative, whatever the case may be, we always figure out that exit strategy, right? If we need it.
God forbid. Yeah.
And I don't mean exit in terms of negative of like having to sell the house.
Oh, okay, good.
My exit strategy is always financing strategy. So I have clients right now that I'm working with who are looking to purchase a home. They're literally looking to do this. They're going from a townhouse to a home probably around that $1.82 million mark.
Right.
And they're like, well, what do we do because we don't qualify? He went from a salaried employee to self-employed.
Tough.
So I have options for them because I have alternative. And my exit is, okay, do we do this for a year or 2 years? And a lot of the time I get the accountant involved and the realtor involved to have this holistic conversation.
It needs to be a team effort.
Yeah. And does it make sense for them to pay a 1% lender fee to access that home today instead of claiming more on their taxes?
Right.
And, that the income that could be lost in that regard. And a lot of the time it's just taking that next step and figuring out your options and working with the professionals to get there.
Right. I mean, I always say to clients, like, no matter what budget you are working within, it's never enough for that person, right? So there are people who hear you say, wow, they get to buy a house for $1.82 million, but I also know people who are in the $4 million range and it's not enough. And then I have people who are in the $500,000 range. So, I think that, so I want to clarify something just going back. So, speaking to first-time buyers and saying, okay, we need a down payment if we're going to get a property that's over $1 million. Okay, fine. What if I own something that is, that has $100,000 worth of equity in it, and I want to buy something, like I'm going from a $700,000 condo to 1.2. Do I still need 20% down to get over that $1 million?
Yes.
Even if I own something, doesn't matter.
You have to have 20%. However that comes, whether it's equity or gift or extra down payment, it has to be, you have to have 20% down. When you have under $1 million, right, it's considered insured or insurable.
Yeah.
And then ultimately what you have is 5% of $500,000.
Right.
Nowadays, what can you get for that? But as an example, like a $750,000.
You can, by the way.
Okay.
And
So
by
that-
the way, I would do that before rent. You know, if you can, do it before renting. If
There
you
you
could do
go.
it,
Okay.
yeah, for sure.
But say a house like 750,000, you need 5% of the first 500,000, 10% of the extra 250.
Right.
So you got a total down payment of $50,000. So that works. I mean,
Calling
again,
all people with $50,000.
yeah,
right?
and then again, there is mortgage insurance that's associated with that because anything
Right.
under
So
20%.
you did some numbers.
I did because
Yes.
I know how much you love numbers.
Yes.
So I'll show you here.
Because I think, and also I kind of want to chat about bridge financing a little
Okay.
bit, because I think sometimes, I can advise a client, and it's definitely based on their financial. So speaking of
Yes.
the case that we dealt with, I would never want to see someone homeless, but they were the people that needed to know exactly how much money they had in the bank. And so we had to sell first. And then they were, thank God, had a place to live, not without its shortcomings, but they had a place to live that they ended up staying for almost a year. But ideally, that's not for most people, right? Yeah. So anyway, go ahead. You were
Okay, so here are my numbers. So I'll use a purchase price of $750,000, the down payment of $50,000. So it's your 6.67% down payment.
Okay.
So with being in Canada, one of the three insurance companies will insure that. Their cost would be 4%, so $28,000
a year.
As part of the mortgage or paid up front.
Okay.
So they can build it into the mortgage. Now, if you move to a $10,000 down payment, the premium is 3.1%. So $20,925. And then at 15% down payment, the premium becomes around $17,850. So it starts to get lower.
Let's say they didn't want to add it into the mortgage. Is that an option? Like,
Yeah,
is
they
it
can't. It's not common because
Okay.
usually people will, why would they do that in terms of the capital? Because they could potentially invest that and make more, whatever. That's my kind of personal finance background coming into play.
Right.
But they can pay it up front and then deal with it that way rather than building it into the mortgage.
Yeah.
But they've made
If
it.
you can.
Yeah. And what's interesting, though, is with the way it works here is because when it's insured by the lender, which would be in this case, or an insurable when you purchase under $1 million, you have 20% down. You have the best rates. You get the best rates because it's back-end
By the way,
insured.
that was the greatest aha moment for me in this business. When I learned that, I was like, what?
Yeah. And it's because it's insured.
So repeat that again for everyone to really understand.
So when you were
Who
purchasing...
gets the best rates?
Anybody less than 20% down.
So you would...
Or 20% down under $1 million purchase.
Right. So it's interesting to me because I think, that whole like the rich get richer and, oh, well, the more I have, the better rate my bank would give me. And granted, yes, if you have a good, relationship with the bank, obviously they're going to take numbers off prime, but their prime compared to what they're giving someone who's uninsured compared to insured is different.
Yeah, 100%. I mean, we were at, a few weeks ago, even 4.99% for insured.
Did you hear that? Under five. And I heard US, I was listening to a podcast this morning, and they were saying that they were like, we're going to be at 5 by the end of the year. So.
Yeah. I mean, look, we tend to sometimes move in lockstep. And remember, the fixed rates move with the bond yields, and our variable works with prime. So those are two things to keep in mind. And we've seen interesting drops and then recurrences with bond yields even over the last month and a half.
No, they've been up and down. Yeah,
it's been so I can submit a file, get a rate reduction because I always do that request for my clients, and it could be way lower.
Yeah.
And then 3 weeks later, it's higher again on the bond yields, whereas prime kind of keeps things pretty standard until they drop that overnight rate, hopefully
or until
mid-year.
they hike it up faster than we've ever seen before.
Unprecedented.
Yes,
Yeah.
unprecedented. But we won't talk about rates.
Yeah, we can't talk about rates. We promise.
So, so going back to like, clients will come to me and say, okay, we want to move up. And, listen, I always have that conversation first of like, we can buy first. If we're in a market that allows for that, like last year, I would never have allowed anybody to buy anything. It was a buyer's market. As Benjamin Tal put it eloquently, a buyer's market with no buyers.
With no buyers, right.
Best line ever
he's
of 2023. He is the rate whisperer. But that was that extreme situation where you needed to just sell your house, see what you could get for it if you could sell it, and then go out and like kid in a candy store, right? But most of the time, unless we're extremes, like there's that one extreme and then there was COVID extreme where you would never have sold first because you would be homeless. Most of the time it's very much it's a client decision based on obviously what they're selling. I think that's really important. Is your product easy to sell? Are you like reasonable in a range of what you're willing to sell your house for? And then also what you're buying. So that client who wants to buy within a 4-block radius is going to buy first, for example, not them. But is there any time when you're looking at the numbers where you're like, absolutely do not buy first? Like when that ratio is just like, is there anything you look for that you would say it's just cut and dry?
So, I mean, really, again, it's always case by case, but you'll have clients whereby the biggest thing in the market could be you have generally 90 to 120 days to bridge that, right? If you need that.
120 is the maximum.
Yeah, again, there are banks that might do an exception beyond that.
But let's
usually,
assume 120.
Yeah, 90 to 120 is really
so
that.
So 40 days is not that, 4 months.
Yeah.
Feels like a long time.
It's not.
But if you're in a market and no one wants to feel like they had to buy something because they had to buy it and they didn't buy what they wanted. So you bring up bridge financing, not to jump around too much, but if I were to purchase a house before I sold my house and that new house closed in 30 days and I still owned my original house, I would need bridge financing to own both of them because chances are on paper I can't afford to own both of them. So the bank will, and you would need to speak to your mortgage broker, always speak to your mortgage broker about that before you go out and buy a new house. What are the rates? Like if you were to look at something and say, if I was looking at $1 million mortgage that I had to bridge finance over an extra $1 million or however way, for an extra 3 months, like what by month would you say it costs?
So I'd have to run those numbers. I can probably do it quickly, but in terms of like the general rate, it's prime plus 1 or 2 sometimes.
Right.
So now would be like 9.2%. Usually there's an administrative fee as well that's tacked on. I mean, it's only $500 or so.
Right.
But that, I mean, over those number of days, it can be a few $1,000s for sure. And the bigger the numbers obviously can be a lot more.
Right.
And we get into a situation where they've got to make sure that they can cover that capital as well. And the longer
you have to be approved for it.
Yeah.
Yeah, you have to be approved.
And again, because there's equity in the home and they've already, they have that equity, it'll be okay to be able to do that. But again, it can be several $1,000s to be able to make that work. So,
which I always look, several $1,000s is a lot of money to a lot of people.
Yeah, if it's
so
a big
I don't
number
dismiss
for a number
it.
of days,
I don't dismiss it, but the reality is that I always say to clients like, you have to think about what that price is for you to, if you're a family of 4 and like you have small children, and can you imagine that what would be, what's the bigger nightmare, right? Like that you're homeless. Right? So that's the question. The 2 options when you're buying up is you sell and you don't have a place to live and now you're like panicking, or you have to buy something and you don't love it, or you have no place to live. Just so you know, Airbnbs are not an option.
Yeah.
I've actually had clients who, when we were selling their property, were going to move out. It was the time of COVID. You held back offers. You needed to be able to have people in like early in the morning, late at night. And they had an Airbnb all set up because they were a family of 3 with a dog, and they canceled on them. Like Airbnb could just cancel on you. So that's a major consideration if you don't have family you can live with or family you like. Or you can end up buying a home and not being able to sell. Have you ever had that where someone wasn't able to sell and then they're like, oh my God, if we sell it for $50,000 less, like we can't drop the price. Like that's a really serious consideration also.
So last year I had clients where they purchased a home and they were looking to sell their condo.
Yeah.
And they got down to the wire. Like we're talking.
Because you have to show an APS signed agreement of purchase and sale. It's not just like sell it, buy it. Like you have to show.
It had to close within that period.
Yeah.
And they had to have that. It got to the point where they were even playing around with the numbers on selling and dropping the price. But at some point, you can't just drop your price because you need equity to move into that next home. So I worked very closely with them to say, this is your bottom line to make this work. unless we need to then, you know, cancel an original commitment that we had with an A lender and move.
Or start dialing for dollars with your family.
Yeah. So
Yeah.
so honestly, we talked about numbers. I said, can you get a gift to make this work in this capacity? And it honestly has to be a gift. Or can you figure something else out whereby you move into the home and someone else rents? We were looking at it all out, and I ran rental scenarios for them just in case. We had the realtor on the phone too to figure out what that was. Yeah, it was so stressful.
But why not sell first before buying?
So they found a place, and I was referred kind of mid, which happens.
No, I'm not saying you gave them advice, but like all I can think is, I mean, and listen, I've had that conversation with clients where they're like, okay, so we want to sell in the, like, we're going to buy it and then we'll sell in the summer. And I'm like, you're not selling in the summer. I'm like, I'm not going to sell you. And like, you won't sell your property in the summer, right? Yeah. Like, there's so many ways of avoiding that red flag.
Yeah. Look, in an ideal situation, would be great. They sell their home, they have the time, and then they buy. And if worst case scenario, they have somewhere to go. But sometimes you don't. But it is very, very scary when they end up purchasing and then trying to figure out, because then the pressure's on them and they've got to figure out, can they sell, how much? And then I run those numbers to say, here's your bottom line, because you need that equity to
Nothing makes me nervous in this business until you have clients who are like, they're literally doing it to dollar and cents in a spreadsheet. And it's just like, you know, as well as I do in this business, you can only control what you can control. And so, you know, if there's no room for any error, you know, and that's where sometimes you just have to sell and say, no problem. I have this much money to go buy something. And I think that those are really important conversations. I think that we're moving into another year of, I'm actually really surprised inventory has not gone up. I would expect, like, where's all the inventory that was on the market last year that just seemed to disappear? It wasn't bought.
Are people waiting, you think, till rates start to come down? And
so I have one client who is like, okay, it's gotten better and just wants to get it done. And then I have another one that could hold on to this house for another year if they needed to and wants a certain price, so they'll hold on to it. So those people, it will be interesting, because if they want to come back out and try to get their number, or they take it off, that's a different part of the market. Those people, not to say they're testing or playing a game, but like, they have their own goals, they have their own agenda. That's totally fine. And if they're willing to wait it out, that's fine. The question is the people that actually want to sell in this market. I think we're going to have a hard time finding inventory again.
Wow.
There's nothing to buy right now.
Across the board.
I think that they're smaller condos. I think, like, I would say large size condos. I did a run for a client the other day, and in the Yorkville area, so go all the way to Avenue, all the way to Sherbourne. So you've got that full gamut, like just past the Mount Pleasant extension along Bloor. So that's super condo heavy. Yeah. And condos that were bigger than 1,400 square feet, but under 1.6 million, one.
Wow.
But if you looked at like 700 square feet, 800 square feet, and that like sweet spot of 800, like not even 900, like $600,000, $700,000, and $800,000, there's inventory. Mm-hmm.
Wow.
Mm-hmm. Before we end it, I didn't want to talk about rates, but one of the until now, but one thing that I found very interesting was during COVID, I would never have told anybody to touch a B lender just because of the rate delta was so huge. Like if it was 1% at a traditional bank, it was like 4% at a B lender. And it was very like the people who couldn't or didn't have the credit or whatever it was went to B lenders. But they've gained a lot of like, not notoriety, but they really like that delta has shrunk between the two, and there were a lot more people going to be lenders over the last year or two. Have you noticed that?
Yeah, 100%. And like, there's two primary reasons it's happening. One is just affordability. How do we make this work? We've got our 20% down payment, but we just can't get there with income. Okay, so we need extended ratios, and that's where alternative lending comes in. And the other big space is self-employed professionals.
Yeah.
So I have extended ratios that I can get to a certain point at our A lenders, our traditional banks.
Right.
But that only goes so far.
Right.
And then we need to step in, and or someone who's went from like a salary position to self-employed, something like that, right?
Yeah.
All of a sudden they're not, lenders are like, wait a minute, no, this doesn't make sense. And if it's not in the same industry, it makes it even more difficult.
Worse. Yeah,
so there are alternative lenders that'll take 6 months business bank statements or 12 months business bank statements.
Which like is crazy because sometimes the rules don't make any sense. Like I get it. Maybe I'm speaking because I'm a self-employed person. So I'm like, come on. But, right?
Yeah.
But on the other hand, I also had a client who was in the tech industry who during that time, like we were looking for a property, he got laid off. He listen, he's a young guy, enjoyed his time, still living at home. And he's like, okay, you know what? Little shell shocked. We're going to take 6 months off. Came back, found a new job. No problem. His mortgage broker was like, same industry, no problem. But yet if you're a self-employed person, sometimes you have to go to a B lender.
Yeah, 100%. And again, speaking to what we did before, that's when kind of getting your professional team around you to figure out what you can do, what you can't do. And then ultimately, sometimes it might make sense for you from a purely financial perspective to go to an alternative or B lender, simply because to put that extra money down and pay yourself more, the taxes can vastly outweigh your extra cost from an alternative lender.
Listen,
so I'll run those numbers.
No, we'll put Craig's contact information in the show notes. Reach out to him if you have any questions. I almost believe, and it never works this way, whenever I'm referred to someone and they kind of start with me and then they're like, now we're going to interview mortgage brokers type of thing. I find mortgage brokers should be the first. It's not the fun part. I'm the fun part. I get it. I'm the one who's going to send them, I'm going to send them all the goodies to look at. Sorry, they've got to collect their T4s for you and all that stuff.
Lots of fun.
So yeah, not as fun, but I almost really believe that you should be their first stop because you need to understand what the options are and then, be able to go out, understanding your budget a little bit better.
Yeah, 100%. And that's literally my raison. I want to make sure they're protected, they're secure, they know exactly when they go out with you.
I know.
They're ready to go.
I know.
100%.
Yes. Well, thank you so much. And I also just want to give a big shout out. I think it's great that you are going to be teaching at or you're going to be doing guest lecturing at U of T. They, at least whoever the one professor is who believes that, younger generation needs to have financial literacy. I think they should be doing it at the high school level, but
100%.
Don't be a high school teacher, but yes.
Definitely not. Yeah, so it's actually going to be student driven. So the students are coming up with the podcast questions, the financial questions that they want to know about mortgages and real estate and finance.
Amazing.
And we'll have different people on calling it Wealth Whiz. So like Wealth Wizards. Oh. And I'll speak about a lot of things related to finance and mortgages, but we'll bring on realtors and accountants. I was
going to say, if you want, I'm happy to join the podcast.
Yeah, that's exactly it. And so they'll have, as students coming out of university, what's good debt, what's bad debt.
Love it.
And have
and
the
maybe
resources
they can
need.
think about, is it a possibility or is it not? Right.
That's exactly it. Yeah.
Thank you.
Thank you for having me.
All right.